Here's a number that should bother you more than it does. If you've done a good job saving for retirement, if you've got a couple $1,000,000 sitting in a 401k or a traditional IRA, there's a very real chance that the single largest expense of your entire retirement won't be healthcare. It won't be travel. It won't be helping your kids or grandkids. It will be taxes. And not because you did anything wrong. The opposite, actually. You did everything right. You maxed out your 401k. You got the match. You deferred and deferred and deferred. You built a beautiful, enormous pile of money that you've never paid a dime of tax on, which means the IRS owns a chunk of it. They just haven't told you how big the chunk is yet. Today, we're going to talk about the structure of retirement income, what I call the retirement income tax stack, and specifically the 3 phases every retiree moves through. Because if you understand the phases, you can see something most people never see until it's too late. There's a window where you have enormous control over your tax bill, and that window slams shut at a very specific age. Most people sleepwalk right through it. I'm going to show you how not to. This is the bracket. Let's get into it. So let's start with the foundation, because if you don't understand this part, none of the rest makes sense. When you're working, your income is simple. You get a paycheck, it's taxed, and you're done. You don't really have levers to pull. The income is what the income is. Retirement, though, is completely different. In retirement, you're the one deciding where your income comes from, and different sources of money are taxed in completely different ways. That's the whole game. Think about the buckets of a typical retiree is drawing from. You've got your taxable brokerage account. That's the money you've already paid tax on. When you sell something there, you only pay tax on the gain, and often at a preferential long-term capital gains rate. Some years, if your income is low enough, those gains are taxed at 0%. Then you've got your tax-deferred accounts, the traditional 401k, the traditional IRA. This is the big one for many of my clients. Every dollar that comes out is taxed as ordinary income at your regular tax rate, the same as your paycheck. And then you've got your Roth accounts, which is money that comes out completely tax-free, assuming that you follow the rules. And then you have Social Security, which has its own bizarre, frankly kind of insane set of taxation rules that we'll get into. And here's the key insight. Because each of those buckets is taxed differently, the order and the amount you pull from each one determines your tax bill. 2 retirees with the same exact net worth and the same exact spending can pay wildly different amounts of lifetime tax. 6 figures of difference, sometimes even 7, purely based on the sequencing. That sequencing is what we manage, and the reason it works is that your retirement isn't one long uniform stretch. It moves through 3 distinct phases, and each phase gives you a different amount of control. So let's walk through them. Let's start with phase 1, the golden window. And this is the phase that runs from the day you retire until the day Social Security and required minimum distributions kick in. For a lot of people, that's their early 60s, say retiring at 62, 63, 64, before they've turned on Social Security and well before the required distributions start. This is the golden window, and I want you to really hear me on this. This is the most powerful, most flexible, most valuable tax planning window in your entire life. Nothing else comes close, and here's why. In phase 1, you have almost total control over what your income looks like on paper. You're not forced to take money out of anything. Social Security isn't running yet. RMDs haven't started. So your taxable income can be whatever you decide to make it. And here's the part that trips people up. Most people retire and their instinct is to say something like, I'll live off my cash in my brokerage account, keep my income super low, and pay almost no tax for a few years. And it feels great. They look at their tax return and it's basically 0. They feel like geniuses. That is very often a catastrophic mistake, especially for those of you who have saved $5 million or more with at least 7 figures in pre-tax retirement accounts. Because what they've actually done is waste the most valuable tax base they will ever have access to. And let me explain what I mean by tax space. Our tax system is made of brackets. In phase 1, with low income, you're sitting near the bottom of those brackets. The 10% bracket, the 12% bracket, the bottom of the 22% bracket. All of that low rate space is sitting there empty and available. And every year you don't use it, it's gone forever. You can't save it. You can't roll it over. It just evaporates at midnight on December 31st. So the move, and this is the core of what we do here at Nav Wealth in Phase 1, is to deliberately fill that space up, usually through Roth conversions and capital gains harvesting. A Roth conversion is when you take money out of your traditional IRA, pay the tax on it now, hopefully from your brokerage account or cash you have on hand, and then you do this on purpose voluntarily and move it into a Roth where it grows tax-free forever and never gets touched by required distributions. And I know voluntarily paying tax feels insane. Every instinct in your body says defer, defer, defer. But think about what you're actually doing. You're taking money that was going to be taxed eventually, no matter what. That traditional IRA is a tax bill waiting to happen, and you're choosing to pay that bill while you're sitting in the 12% bracket instead of letting it explode later when you're forced into the 22, 24, or 32% brackets. And that's the trade. Pay a known, low rate today to avoid an unknown, higher rate tomorrow. We call the strategy of doing this systematically the conversion corridor, which we covered in episode 1. And this is when you're filling specific band of bracket space each year, right up to the target ceiling and no higher. And here's the kicker on Phase 1. Every dollar you successfully move out of the traditional IRA is a dollar that is not sitting in there later, getting forced fed back to you as a required distribution you didn't need or didn't ask for. You are literally diffusing the bomb 1 year at a time. We also use capital gains harvesting in this window for those who might have more of their assets in brokerage accounts. They might have been business owners who built a brokerage instead of retirement accounts for flexibility, or tech workers who held their RSUs for years and have large unrealized gains. Regardless of how they got the balance, the idea is simple. You can realize capital gains tax-free if your taxable income stays below a certain threshold. In 2026, that number is $98,900 of taxable income for a married couple and half that for a single filer. So a married couple whose brokerage pays $50,000 in dividends and interest and capital gains distributions and nothing else, it would break down like this. They take their initial $50,000 of income, and that is just the beginning of their stack. Next, they want to subtract their deductions. For simplicity, this couple just has the basic standard deduction of $32,200 this year. Take that from the $50,000 of portfolio income, and they have roughly $17,800 of taxable income so far. The next step is to take that $17,800 and subtract it from the $98,900 taxable income limit for tax-free capital gains, and this couple can realize $81,100 of capital gains completely tax-free. Again, this is for people whose portfolio skews more towards brokerage, but is still a huge opportunity to limit lifetime taxes. The golden window is usually only a handful of years long, 5, 6, 7 years if you're lucky, and it's the single highest leverage period in retirement tax planning. If you waste it, you can't get it back. Okay, now on to Phase 2. This is when Social Security kicks in. Now when you turn Social Security on is its own enormous decision. Delaying to 70 to maximize the benefit is often the right call, and that's a whole separate episode. But whenever you do turn it on, you've entered Phase 2. And Phase 2 is interesting because you're still flexible, you still have levers, but you have got a new permanent guest at the table eating into your space. Social Security income is now flowing in whether you need it or not. Here's where the tax code does something genuinely strange that almost nobody understands. Social Security benefits are taxed based on a formula involving your provisional income. And depending on your other income, somewhere between 0 and 85% of your Social Security benefit becomes taxable itself. The reason this matters so much is as you add other income, say from a Roth conversion or from an IRA withdrawal, you can simultaneously be pulling more of your Social Security into taxability. So one extra dollar of withdrawal can effectively get taxed and drag a chunk of your previously tax-free Social Security into the taxable column right alongside it. Financial planners call this the tax torpedo. Your effective tax rate on those dollars can spike to numbers that look impossible. So Phase 2 is a bit of a tighter dance. You still have flexibility, you can still do conversions, you can still manage which buckets you draw from, but the room is smaller, and the interactions are nastier. Every move has to account for what it does to your Social Security taxation, and for those of you on Medicare, your IRMA surcharges, which are the income-based premium increases that hit 2 years after a high-income year. The work in Phase 2 is about precision. You're threading income through a narrower needle. You might still convert, but to a lower ceiling. You might lean more on your Roth and brokerage buckets to keep provisional income controlled. You're managing more variables with less room. But here's the thing I want you to hold on to. Phase 2 is still flexible. It's still a phase where you're making good choices. The reason that matters is everything we do in Phase 1 and Phase 2 is in service of softening the phase that comes next, the phase where your choices stop. And that brings us to Phase 3. This is the one that nobody plans for, and it's the one that wrecks people. Phase 3 begins when required minimum distributions start. Under current law, that's age 73 for most people retiring now, moving to 75 for younger cohorts. And the moment RMDs begin, the game changes completely. Here's what an RMD is. The government has let you defer taxes on traditional IRAs for decades. Now they want their money. So they require you to withdraw a percentage of your account every single year, whether you need that money or not, and pay ordinary income tax on every dollar of it. The percentage starts at around 3.7% of your portfolio value and climbs every year as you age. The IRS publishes the divisor. You don't get a vote on this. And this is the part that stings. The RMD is calculated off your account balance. So if you follow the traditional advice in Phase 1, kept your income low, let that traditional IRA keep growing untouched, never converted a dime, congratulations, your account is now enormous. And your RMD is a percentage of that enormous number. The better your investments did, the bigger your forced withdrawal, and the larger your tax bill. For a married couple, say with $2.5 million, $3 million in traditional IRAs, the RMD in their early years can easily be 6 figures annually, on top of 2 Social Security checks, on top of portfolio income, and on top of potential pensions, whether you spend it or not. The income stacks on top of everything else and shoves you up into higher brackets, and it keeps you there. It inflates your Social Security taxation. It triggers IRMA surcharges on your Medicare premiums. And when one spouse passes away, the survivor gets pushed into single filer brackets while keeping most of the income, the widow's penalty, and the tax bill can actually go up for the person who's now living alone. In Phase 3, you have almost no levers left. The income is mandatory. The amount is dictated by a formula. You're just along for the ride, watching money you don't need get pulled out and taxed at rates you can't control. This is the destination. The question that determines your entire retirement tax bill is, what shape is your traditional IRA in when you arrive here? And the shape was determined entirely by what you did or didn't do in Phases 1 and 2. So here's how we think about it, and here's the whole philosophy in one sentence. We use the flexibility of Phases 1 and 2 to shrink the problem in Phase 3. That's it. That's the strategy. Everything we do is about recognizing that you have a finite window of control and using every bit of it deliberately while you have it. In practice, that means that the year you retire, before you turn on Social Security, before RMDs start, we're not celebrating your low tax bill. We're looking at all of that empty bracket space and asking how much of your traditional IRA we can move into a Roth at low rates. We're filling brackets on purpose. We're topping off the 12% and the 22% bracket year after year, draining that traditional IRA down before the government can force it out at higher rates. We're coordinating the Social Security start date with the conversion plan so they don't fight each other. We're watching the IRMA thresholds. We're modeling the survivor scenario, because planning for 2 people and ignoring what happens when there's only one left is how families get blindsided. And the payoff is real. By the time RMDs arrive, the traditional IRA is a fraction of what it would have been. The forced withdrawals are small. A big chunk of your money is now in Roth accounts, coming out tax-free with no RMDs at all, and passing to your kids tax-free. The bomb gets diffused before it ever goes off. The retiree who does nothing paid the maximum. The retiree who used the window pays a fraction. Same money, same lifestyle, wildly different outcomes. The only variable was whether somebody was paying attention during the years that mattered. What we find with our average client who tends to start retirement with around $5 million total and will have that portfolio double by the time they hit RMDs is that this approach will save them 5 to 7 years of their spending needs in taxes. That's the average case. By realizing taxes at lower rates evenly throughout their golden window and after they take Social Security, our process at NAV Wealth is saving them years of spending needs. This decreases portfolio drain, leaves more money for heirs and charities, and helps alleviate portfolio stress and the fear of running out of money. So here's what I want you to take away. Retirement income isn't one thing. It's 3 phases and they're not equal. The early years feel unimportant because the tax bill is low, and that is exactly the trap. The low tax bill is the opportunity. The flexibility you have early is the most valuable thing you own, and it has an expiration date. If you're in or approaching that golden window right now, this is the conversation to be having. Not 5 years from now when the window is closed and the choices are gone. If you want us to map out what your 3 phases actually look like with your numbers, that's the work we do every day at NAV Wealth Partners. There's a link in the show notes to book a time. I'm Ryan Knoll. This has been The Bracket. We'll see you soon. That's it for this episode of The Bracket. If something here made you rethink a decision you were about to make, that's the whole point. Go deeper before you act. And if you want help applying any of this to your own situation, the team at NAV Wealth Partners does exactly this work. Tax strategy for the distribution years, for households like the one this show is built for. There's a link in the show notes to schedule a conversation with one of our advisors. Click to see if you're a fit. And if this episode was useful, do me one favor. Follow the show and leave a rating wherever you're listening. It's the single biggest thing that helps another retiree with the same questions actually find us. Quick but important note. Everything on this show is educational and for general information only. It is not personalized investment, tax, or legal advice, and listening does not create an advisory relationship with NAV Wealth Partners. NAV is a registered investment advisor. Your situation is your own. Please consult a qualified professional before acting on anything you heard here. I'm Ryan Knoll. Thanks for listening to The Bracket.